Welcome everyone. Thanks for joining us for today's Master Investor webinar entitled Creative Destruction and Coronavirus as a Catalyst for Change. As investors, we're all entitled to feel pretty shell-shocked after the experience of the past several months. This really was the blink and you missed it bear market, with the severity and speed of the sell-off matched only by the strength of the subsequent market rebound. But in the era of COVID-19, all stocks are most certainly not created equal. And there has been a notable divergence in the performance of different sectors and businesses during the crisis. The question for today is whether this creative destruction on steroids has permanently raised the growth trajectory of some businesses, whilst accelerating the decline of others. To discuss all this, I'd like to welcome Catharine and James Carthew to the show. Welcome, guys.
Hello, good afternoon.
Catharine is Corporate Strategy Director at Scottish Mortgage Investment Trust, which I'm sure many of you probably own in your portfolios. I think it's the biggest investment trust, and it's in the FTSE 100 now, right?
That's correct.
James is a director and head of company research at Martin & Co, who operate the QuotedData website, where you can find lots of interesting research on closed-ended funds. And I think I'm right in saying that all that's free to access, James?
Yeah, everything's free. Yes.
So before we begin, just to say, you can keep your questions coming throughout the webinar, and we'll do our best to get through as many of those as we can at the end. We are live, so obviously we might encounter some technical difficulties, but do please bear with us. And you may see that there are a few other windows and a few people operating in the background, but those are my glamorous assistants, so you don't need to pay too much attention to them. To begin with, can we just get the first poll question up, please? So to kick off the discussion, guys, what extent do we think that the current crisis has accelerated the processes of creative destruction and is kind of leading to a reimagining of the way that the economy operates? And Catharine, can you kick off for us, please?
Yeah, so there have been a number of changes in place that are sort of at the beginning of the take-up. Really driven by the digitalization of a number of industries. So I think the ones we're probably most familiar with is in commerce, so the e-commerce platforms like Amazon, or here in Europe you have Zalando for clothing, the entertainment platforms for that, be it social media or companies like Netflix. And what they're doing is changing the microeconomics of the industries they're competing within. So Amazon isn't so much a technology company in the retail sense, it's another shop front that is more efficient than a high street retailer. And so we're really thinking about that. The challenges we've all had to face in these difficult times with the pandemic has really accelerated some of those. I heard one person describe it as a decade's worth of accelerated growth in about 3 months, which feels about right. These are trends that were already taking place but have really accelerated, and for us as long-term investors, really the question is how many of those new customers that have had to use these services in lockdown will remain because the experience gives them something that they can't get or is better than what they can get elsewhere longer term. So
I think what we've seen over the past few months, as you've just mentioned, is accelerated change, and we've seen that in the share prices as well of many companies. To what extent is that a flash in the pan? I mean, how many of these trends are going to sort of, continue to develop longer term, and how many are we going to see actually, sort of revert to the mean, as it were, do you think?
I assume that's back at me, James. So I think the key here is about saying, what are they offering? And it's not just here in the UK, but for example, some of the very basic services like food delivery, be that through your grocery order or be that through your online takeaway, has really been a trend that's already been in place and growing. Actually, the UK is sort of somewhere in the middle. China really leads the way in this way. One of the big companies that we hold is a company called Meituan Dianping. And what they do is predominantly they started off as a food delivery in the sense of takeaway delivery platform. They now deliver 30 million meals every day. Their target is 100 million meals a day. This is just an extraordinary size. What the lockdown has meant is they have utilized their ability in functionality around autonomous robots to deliver so they can minimize human-to-human contact. For those deliveries that were by humans, they had a temperature check so that you had the reassurance that your food was being delivered by somebody who didn't have a temperature. So these companies are working very hard to make the experience in lockdown helpful. Now we know that the reality of human behavior is that the likelihood is that hopefully when we all come out of this, you will have a very human response and people will want to go back to being social creatures again. We're all going to want to go to restaurants. We're all going to want to see people face to face, not via Zoom. The question becomes, what does this do to the long run trends that we thought we were already in place? And actually what we think is likely is that, of course, there'll be some pullback. You know, we won't all be doing as many Zoom calls as we have been, but actually the enterprise case for using Zoom in replacement to some of the meetings you would have done by getting on a plane seems to us to make sense. And the more you get experience of exactly how much interaction you can get through these video conferencing facilities, the more likely you're going to see that long run structural growth story brought forward. And so we think that there is something long term as well as that near term bump in some of these companies. Others will struggle. You know, luxury goods companies that we own like Caring are likely to have a very tough near term outlook. But again, you have that very human desire of release once these things are over. And longer term, we believe the trends that have underpinned growing demand for luxury goods around the world will continue. So it's really taking that step back and just trying to analyze them on that 5-year and beyond basis.
Yeah, I'm really interested in the potential for incremental sort of improvements in productivity with what's going on at the moment, because obviously, as you were saying, you know, we might not be doing as many Zoom calls in future, but presumably a lot of businesses are going to look at the way that they've been operating in, you know, the past several months and realize that actually, you know, they can actually operate with a much lower cost base in terms of office space, you know, even staff numbers, that kind of thing. So James, what's your take on that? I mean,
yeah, I think that the reduction in use of offices is probably one of the big changes that we're going to see. Because I mean, I'd be quite happy to carry on working from home a lot more than I used to. And I think I'm not alone in this. And I thought for a long time that it doesn't really make sense, the amount of money that companies spend on corporate travel. And it's quite obvious now that they don't need to do as much of that. So you have to think that there must be a long-term impact on airlines and travel companies. There must be a long-term impact on offices too, but maybe we'll just spread out and occupy the offices, but with fewer people in them. So I think those sort of trends are probably here to stay. And online shopping is one of these things that people probably wanted to try, or they tried it in the past, it didn't really work because there was nobody in to collect it or whatever. Now it's becoming much more ordinary to do that. So I think the online shopping numbers are definitely going to keep going up, which has big implications for high street retail. So that it's as we said, the title of this is creative destruction. There's a lot of destruction going on as well as the creation of new opportunities.
Yeah, and it does seem that seem that the gulf in between these old economy companies, as we might call them, so like the bricks and mortar retailers and the internet retailers, is just becoming wider and wider, and that's being accelerated by this crisis. And you've got, you know, examples of companies such as Amazon that are using the crisis to sort of reinvest profits and, you know, grow for the future, whereas, you know, you've got a lot of the old economy companies that are actually having to raise capital through, you know, rights issues or, you know, drawing on credit lines or whatever it might be. So, I mean, when you look at these companies, is there potential for, you know, rebounding some of the old economy companies, or should investors really just be looking at, you know, the companies where the long-term thematic trends are on their side?
I'm sure Catherine's got some strong views on this. I think the sort of value argument that things will revert to the mean, it doesn't really hold up in areas where you have got a a trend towards something new. So if you think about high street retail, for instance, it's very hard to see how you can actually make use of all of those shops again. And retail property was quite expensive to rent. So rents will have to come down. And one of the things we're seeing as an innovation now is that some landlords are saying, well, we'll do turnover rents, where we, instead of just taking a fixed amount of money, we'll actually take a percentage of the profits you make. And that sort of participation in the economy of their clients may be one way forward. But it's, yeah, there are so many questions posed by this. High street retail is probably one of the places that I can't really see coming back. But against that, you've got people doing the nuts and bolts of doing the fulfillment of the e-commerce stuff. So we've got lots of funds now that do the warehousing, the logistics side of things, and that's booming because people like Amazon are just taking more and more space.
Catherine, can you just talk us through the Scottish mortgage portfolio and just have a, sort of dissect some of those themes that you think might be well suited to the current environment and, the long-term implications of coronavirus?
I think it's just worth going back a step and talking about the Amazon point and about how, as investors, some of the challenges that we as an industry put into public markets actually sort of self-reinforces some of the unhelpful behaviors of companies. So a demand for predictable earnings results on a 3-month rolling business basis is absolutely a nonsense way to run your business. One of the strengths of businesses like Amazon has been the preparedness to say, we just don't care. If that's what you want, you look elsewhere. But as investors, what we're doing is saying, what do they actually do with their capital? And Amazon are remorseless about investing for a 10-year and beyond time horizon. So in the last global financial crisis, we know that they heavily invested in their business. They weren't trying to kind of make quarterly earnings numbers. They really just don't look at that. And you can see now they haven't retrenched. They've hired hundreds of thousands of people. They have increased wages per hour right across the board. They have thought about, well, we'll distribute the key goods first because we're seeing such a step change in demand for our services that we need to think about how we best facilitate what everybody needs. And then we're going to invest $4 billion in the next 10 years. And we know from the global financial crisis that actually it's that willingness to invest at times like this, to have the capital to make that sort of long-term investment and forego short-term profits, that really cements your position over time and gives you a better chance at serving your customers' needs. Because ultimately for all these companies, if they don't meet their customers' requirements, if they have a better opportunity elsewhere, then their customers will leave. And really that's the key competitive threat we see for these businesses, is how they behave. And I know we've got a question coming up on that. But I think it's really important as investors that you are quite clear that the way that you behave and provide capital into the markets has a knock-on effect of how companies are run. And what we've tried to do for Scottish Mortgage is say, right, we're going to be long-term providers of capital to businesses that we think have the potential to grow, that have the potential to really cement their competitive advantages in large end addressable markets. And often that does mean either doing an existing business in a better way or creating an entirely new opportunity. I don't mind where we want to take it in terms of the portfolio's exposures we have. There's obviously quite a lot of different ones there, but I think that's a good basic point to start with.
Sure. And what about some of the other themes that might sort of, get a bit of a fillip on the back of what's been going on lately? So things like the shift away from fossil fuels towards renewable energy.
And that's a huge thing already, really. There's stories this week that it's almost 2 months now since we've used coal to generate electricity in the UK. And it really won't be very long at all before all those plants are shut down. They were all scheduled for closure. And what they seem to be doing now is just burning through the stock of coal that they've got. And once that's gone, there'd be not much point keeping these things going. So there is a big shift going on in the way that we generate fuel. And there are so many funds now that are looking to invest in solar and onshore wind and even offshore wind as well, which is very expensive, I think, to develop and maintain. But it's all cost competitive now with fossil fuels. And as the cost of generating and installing new plant falls, there's going to be ever more increasing shift towards renewable energy. But that requires changes to the plumbing in the way that the grid works. So there's opportunities, again, for all sorts of businesses doing that.
So I think this is a really important point, and actually it's been coming a lot longer than this crisis. Actually, if you look over the last 12 months, 6 months before the pandemic struck, and look at what the destruction of over 100 billion in market cap in the fossil fuel industry was telling you, was that we'd reached this tipping point. So energy generation by solar has fallen in cost terms over the last 40 years by 99%. One of the reasons that we hold Tesla in the portfolio is that actually this is one of the few really big companies that we believe has a competitive advantage and can grow its business in this area. The challenge for many investors is a lot of the best businesses in battery storage have been in terms of private companies and are therefore not accessible. And we're really looking at the point in time of where do you get to that J-curve, because it's clear that we can't keep burning fossil fuels at the rate that we were. And we've been saying for some time, you know, this is not going to change because people make just a simple judgment about that. It's going to come because these energies will get, James, as you were saying, to parity, whereby it's just cheaper to buy an asset that you know how long its useful life is. You can depreciate it, you can plan for your business. You don't have the variability in your input for energy costs that fossil fuels give you. That tipping point is coming, and we would say you could see that being told in the market, you know, as much as 12 months ago. And people can check, you know, we've said this for a number of years, the age of fossil fuels is numbered because it has to be. But you will see it once you get the economic dynamics coming. The challenge for us as investors has been, what are the large companies that you can actually invest in to do this rather than a broad spectrum? And we, at the end of the day, are fundamental investors in individual companies for the long run, rather than trying to play a theme, albeit that often these sort of themes really power the growth of the companies we do pick. And
Tesla's a very large holding in the portfolio, isn't it?
Yeah.
I think most people see Tesla as an electric car company, but they don't actually realize that it's also got, you know, major interests in solar power and also batteries. So just give us a bit of an insight into what you see, you know, the long-term upside in Tesla to be.
Yeah, so I think it's important to say that Tesla is a good example of an extraordinary business run by an extraordinary individual. And if you were running it to a balance sheet with a 3-year Wall Street incentive plan, you would never create Tesla. So to give a sense of the challenges that Tesla faces, is we've always said, look, this is a car company. It's going to take a lot of capital. We knew that when we invested back in 2013, but they had already reached the commercial production run of tens of thousands of units, which is your first hurdle rate. What we wanted to see at that point was you getting from producing tens of thousands of vehicles to hundreds of thousands of vehicles a year. They've done that. Our next challenge is to see how they keep producing that, how they develop new facilities rather than just the Fremont. So we've seen that, you know, the facility in Shanghai took under a year from breaking ground to production. That's extraordinary. What we're seeing is what you want, which is the incremental improvements as they move from one model, the S, through to the X, to the 3, and to the others that are coming down the pipeline. You want to see them rapidly learning the lessons and implementing that. For Tesla, this is about growing your business because they don't have existing combustion engine sales to forego to sell electric vehicles. One of the interesting quotes of the year that didn't pick up much press coverage was actually Herbert Diess at VW gave you a sense of the challenges the incumbents face in the internal combustion engine legacy businesses. So he estimated that it would take 33 billion euros over the next 9 years to move to produce 26 million electric vehicles. Now, it's highly unlikely that VW will manage to sell an additional 26 million vehicles on top of their internal combustion engines. So for them, they're having to change their business model. They're having to adapt to survive. And we know from history, from Kodak onwards, that tends to be extraordinarily difficult to do. For Tesla, for us looking out, you're right. The core part of the business is about growing that vehicle production, about the opportunity in China, which is very clear about the move to electric vehicles. But then longer term, it's also about Solar Cities business, the solar roof tiles, combined with their capacity in static battery storage. And I think anybody who's really interested in this, look at the success of the Australian system that Tesla put in around their solar array, because actually it's about the energy transfer in and out of the grid and the efficiency there. There's huge savings to be made there. So there's lots of individual areas of the business that we think are really attractive. This is not us saying that Tesla will definitely succeed in all its extraordinary ambitions. It's about looking what we have to pay today and how much they could be worth if they succeed in all of their extraordinary ambitions. And what if they don't quite get there but come down that scale? And how much money would shareholders make at that point? And then balancing that against the risk to the capital invested. The tipping point, and it really ties back into our earlier conversation around energy generation, is it feels like last year you saw that critical point starting to be reached with them reaching the production levels and the cash flow generation from the Model 3 that we wanted to see. So this is about probabilities and possibilities. It's not about saying we definitely know what this is going to happen. But I think that's quite important for the future, is that shift to electric vehicles and who has the best exposure to that.
And any other themes in the portfolio that you think are important going forward?
So I think, again, it depends on how broadly you define this, but the digitalization of businesses right across a broad swathe of industries, ones that you might not automatically think the cutting edge of that technology. So we own a company called Convoy in the US, which is created by two gentlemen who used to work at Amazon. And what they've said is, look, trucking is very behind. It's still very much done by people ringing up orders through phone. If you put that through a digital platform, most truckers now have a smartphone in their cab. You don't even have to make that kind of capital allocation to put your business into each cab. You can then track and trace, and it's more efficient for every member of that circle. So particularly for the truckers themselves, it reduces significantly the empty miles driven to pick up the next job, because that network just becomes much more efficient. And there's a similar business in China called Full Truck Alliance that we own, again, that does this. And these are $700–800 billion businesses a year that sit behind those trends we're talking about of, you know, internet shopping is one, but it's also just about moving all sorts of goods around these large countries. So we think these are really interesting, and that dynamic that we've seen elsewhere in terms of what that can do to the business models and how difficult it is to compete against them apply to these businesses too. I think the other key area where you've seen it is the rise of genomic sequencing and the really extraordinary cost falls that accompany that allow you to use that more broadly. If you think about the current situation, how quickly we were able to sequence the virus and how that allowed us to then start developing targets for both treatments, but also for vaccines. You know, that's a key shift, and a lot of behind the scenes of that is also about the digitalization. The ability to process the volume of data that creates is really important, and these are really exciting and promising shifts.
And when we're looking at some of these growth companies where, you know, the valuation, if you can actually value it on a PE basis, is, you know, stratospheric. How should investors be approaching this? Because it's very easy to write off a lot of these companies, isn't it, based on a valuation basis, and just be too scared to even touch it, because, you know, you can't really envisage a situation where it actually, you know, reaches anything near. So James, how should investors be approaching this when they're investing in great companies like these?
One of our clients is Polar Capital Technology, and Ben Rogoff, who runs that, his analogy is, well, investing in something that's going from 3 or 4% penetrated to something that's 60% penetrated. The growth in sales and profits is almost exponential. I mean, the growth from going from 73% of people to 60% of people is just, he says that analysts find it very hard to model, and therefore people run scared of paying up for these businesses. And what he suggests is basically you should just try and identify those themes and ride the best players in those markets, because they will make money all the way up. And then by the time you've got a technology that starts to look mature, then that's the time you think you should be moving on to the next big thing. So there's always new stuff coming through. And that's kind of what Scottish Mortgage is doing, I think, across a whole range of different industries. It's just like trying to identify the winners of the future, who's going to succeed, what's the size of the market, and potentially what's the market potential if they take 20% of the market share or 10% of the market share in, and how big could that market be? So that's the sort of numbers you have to start playing with. And just looking at a multiple of sales or a multiple of book or a multiple of last year's earnings, it's kind of meaningless for things like that.
Catharine, I think one of your fund managers called it investing in growth at an unreasonable value. Sorry, an unreasonable price. Do you care to sort of embellish on that a little bit?
Yeah, absolutely. So the bottom line is, when you're investing on the long term, the notion that you can come to one single price that you know what's going to happen. We would say the challenge of doing that over, as we've seen quite clearly, over even 3 months or 6 months is impossible, but it's certainly impossible over 5 years. Ultimately, a business is worth what it can generate in free cash flow. The earnings number for businesses is heavily reinvesting its capital, that has a track record of producing a return on that capital that looks very attractive compared with the average market rate, means that earnings number, which is what you're left over at the end, just doesn't make sense as a way to judge these businesses, particularly when we know that where you see long run growth trajectories that are not linear, but are exponential, James, as you said, which are these businesses where you see an accelerating trend, the market is phenomenally bad at pricing these. If you look at Microsoft from the 1980s onwards, if you look at Amazon, you know, if you'd have bought Amazon at the height of the TMT bubble, you would have made a lot of money if you were prepared to be diligent and hold on to it as it continued to cement its business, and accept that it was actually a retailer who didn't have to run to stand still by investing in bricks and mortar infrastructure, but whose infrastructure in a digital platform got better through the use of Moore's law, where computing power roughly doubles every 12, 18 months, meant that it was a better business model. So really what we would say is, look, particularly for businesses that are as complex as Amazon is today, you've got several different areas. It's both a first party and third party retail platform. It's also a web services provider. And one of the areas we haven't touched on yet is just how important web services, distributed computing in that sense, is to what we're seeing today. You know, these are huge businesses in their own right. And so actually it's about analyzing what you're buying in an individual company and thinking about it in a world where, and you started at the top by talking about creative destruction, in a world where there are very deep, long run structural changes of the kind of level of importance of a shift in energy generation. You just don't get businesses doing a little bit better or a little bit worse and mean reverting. You get deep value destruction in the businesses that are unable to adapt to the changes in the world around them. From Kodak on, who had one of the first digital cameras but failed to take up that, to the challenges we see in some of the industries that we've been talking about, we're just not sure that the assumption of the old world safety assets is going to be true, because these structural changes we're seeing coming are just so all encompassing and will play out over the coming decade.
Okay. At this point, I'd like to bring up the next polling question, if we can. So, obviously, over recent months, we've seen the big tech companies become even more dominant than they were before. Does the panel think that that's going to bring with it increased regulation, increased interest from tax authorities, that kind of thing? Are governments and regulators going to be coming out for the likes of Facebook and Google, do you think? And we'll start with James, please.
Yeah, I think it's almost certain that they will do. I think you've got governments now, and it's very hard to know how the governments are actually going to recoup the money that they've been pumping into the economy. But if you're looking for an obvious target, you think they just go after the revenues of the tax dodgers, the multinational companies that aren't paying their fair share. And so whether that's true or not, I mean, you can get into a big debate. But I think that they will be an obvious target for the EU, for the UK, and for the US probably. For the US, it may be more political, and The fact that Trump and Jeff Bezos don't really get on might mean that he looks for ways of taxing Amazon. I mean, one of the other things is the increasing dominance of these businesses, because they've got fingers in so many pies, is whether you start to get regulators looking at them. And that removes part of the attraction, I think, and it would change the landscape for these things.
Is it a double-edged sword though? Because in one sense, increased regulation also leads to, you know, higher barriers to entry and generally sort of favours the dominant incumbent, doesn't it?
Well, it can do, but it also stifles innovation, and innovation, as we've said, is the thing that's really driving everything. So if they say, no, you can't invest in this area because we want to leave it free for other market participants or something, however whatever form it takes, it's generally not helpful.
So I think there are a couple of points. Oh, sorry, James.
Sorry, go on, Catherine.
That I would pick up on, which is the history of regulation suggests that, as James says, it favours the incumbents from Standard Oil onwards. If you break up these companies, it's not clear that actually in aggregate what you get does actually diminish your returns. It's just that the ongoing name may be smaller. And there's a difference here. I think regulation, as you say, can be really challenging for those trying to compete against the incumbents. I'd also say that beware of acronyms and grouping companies together and then applying one heuristic across them. To us, that's our biggest market opportunity. From FANGs, you know, Facebook is a media company. It's all about advertising revenues. Amazon looks very different. We've now got Apple in there. Again, that's a very different business exposure. You've got Netflix as a challenge, and Google is very broad-based, but essentially its main revenue stream is back like Facebook and the advertising stream. We have been reducing our position significantly in Facebook for a number of years now because it's just not as exciting to us as Amazon, which has the potential to grow revenues from grocery shopping and apparel, big opportunities where they're very, very small. For Amazon, what you want to see is that engagement with, you know, increasing the wages. So Amazon already pay above minimum wage. It has also then increased that in the period we're just going through under the pandemic. It's been investing very heavily in helping people get the supplies that they need when we can't just go down to the shops. So you want to see that. I think there's also an element here by you have to do your fundamental analysis and say, you know, we've already seen Amazon make comments saying we would consider separating Amazon Web Services from the main business if that's what regulators wanted. Now, to us as investors, we take a step back and say, given the growth rate of AWS, the web services business, and the margins that that business makes, do we think the market would put a higher price tag on that as a standalone business or as part of the sum of the parts? And the reality is probably as a standalone business. So it's not clear to us that it would be bad if we saw that pressure. Now, very long term, that may not be something that we or the company would be in favor of, but it's not clear that from an investment perspective over the next 5 to 10 years, that would actually be an issue for us as holders. For us, it's about how companies engage with their customers, because ultimately it's the customers who vote with their feet. And that to us is much more critical in our analysis. The other thing I would just highlight is no business is ever going to be perfect. And we do slightly demand in the public space that no company can afford to make a misstep. And that's just unrealistic. What you want to see is them making the efforts to address it and then be realistic that they won't always succeed. And that's right across the board.
And on that note, can we just get the last polling question up, please, which ties into what Catherine's just been saying? Because this is the other threat to these big entrenched technology companies, isn't it? If consumers start voting with their feet and sort of abandoning them. And there's another dimension to all this, because these companies are actually at the forefront of what we might call the new Cold War with China, aren't they? So how does that dynamic play into what we've just been saying about regulations? Because, you know, if given that these companies are actually in the front line, governments might not be actually so keen to go hard on them. Do you think?
James, do you want to go first?
I think it's tricky, to be honest. I think if you're looking at the polling question first, so definitely I think that consumers are much more influenced by the public face of the company and their it's all the ESG aspects, and especially around how they treat their employees, how they treat their customers. But they're quite vulnerable to a CEO making a daft tweet or saying something racist or something, and then getting huge boycotts. And I think that's more of a thing than it ever has been. And because we're not talking about going around the corner to your local shop, which doesn't move and is always going to be there, and you might fall out with a retailer, but go to the one next door maybe. These are things where you can quite easily shift your business, so they are more vulnerable to that sort of thing. So the ESG aspects are really quite important, because if it turns out a company has been polluting the environment for years and nobody really knew about it, and all that comes out of the option, people just stop using their products. So I think that's a big thing. In terms of the kind of political stuff, I mean, I suppose Huawei is the sort of the big face of what's going with China at the moment. I think globalization has stalled and might go into reverse. I think that you might see more kind of political moves, more tariff barriers still. Even the Democrats aren't particularly in favor of a completely open markets. But companies can navigate their way through these things, and some of these companies are still quite nimble. So I think it's not something that would weigh too much in my mind, except in certain specific industries, probably. What do you think, Catharine?
What about you, Catharine? How does the whole theme of deglobalization play into playing to creative destruction and those processes? Because for a long time now, we've had a world where we've been kind of expanding across borders. Companies are international, but huge companies that rely on economies of scale. How does that survive in a world where we're looking at deglobalization?
So I think this is really interesting, because just coming back to the point about consumers, it is consumers have become more global in an internet age, so that you don't get that segmentation for countries to some extent, but it's not true right across the board. So for us, we absolutely agree that it's not just the FANGs and the tech companies, all companies. If you've been a large company that's accessing government funds when you could have funded it from your cash flows, you may well see a backlash post the viral lockdown. I think the challenge here in terms of the long run trajectories of companies is about, again, it's the same idea of you have to look at individual companies. So if we go back 3 or 4 years, we were concerned that Amazon and Alibaba, China's large ecosystem that allows small and medium-sized enterprises basically to operate throughout China, where there's, outside of the large cities we're familiar with, there's much less formalized retail infrastructure. We were concerned that they would start to compete in each other's home markets, and that competition would do as it always does, which is erode markets, and you'd got 2 players with a lot of capital to put to work, both of whom were extremely disciplined long-term allocators of capital. Actually, the rising tensions between China and the US, and we've been talking about this for the last couple of years, is we think it's beyond this current US administration. This is a structural challenge to the US's current dominance, that as China has grown, has increased, because longer term, China will be a very significant global player. This is not about us taking a view on either government system or operators. It's about simply saying, as an investor, you can't afford to ignore this. But actually what it will do is provide a segmentation so that Amazon probably won't be challenged by Alibaba in the US. And it's still, it's the dominant online platform for retail in the US. But if you look at the size of Walmart compared with Amazon, Walmart is still a multiple of the size of Amazon and a much bigger retailer in the US. There's still a huge opportunity there in that area alone. In the web services, You know, we tend to talk of the Amazon dominance. That's just not true. Their biggest competitors who have struggled to catch up are Microsoft and Google. You know, if Google needs help to compete against somebody, you know, it's hard not to argue that they've got the capital to do it. You know, these are not tiny minnows coming after them, and yet they are very firmly number 2 and 3. Google's about a fifth the size of Amazon there. For Alibaba, again, don't underestimate the size of the opportunity in China and the Sinosphere for that company alone. The market that we do think is large and interesting, we can come back to why we don't have as many investments there, is India, where you have seen Walmart, Amazon and Alibaba competing for this new territory, and it has put pressure on potential margin structures. And so actually, yes, we would agree that there is a challenge for all investors and all companies from an increasing separation in international relations, but it's not clear that it's necessarily a bad thing for every company. But you do increasingly have to go down and look at those individual companies rather than just apply one board-based rule against everything.
Scottish Mortgage has been increasing its allocation to private companies lately, hasn't it, Catherine? And I suppose part of that is because the pool of listed equities is actually decreasing globally, isn't it? So to access a lot of these, you know, really innovative, high growth companies, you now have to go into the private market. So do you want to just tell us a little bit about that?
Yeah, I think the key here is that actually there's been a structural change in capital markets, and we're, like every other business, just trying to innovate and adapt to a change in our market. So as companies have been able to access more capital and be able to grow as private companies to a stage where in the past they would have been public companies, we need to evolve our strategy to allow us to keep our opportunity set. So when we invested in Amazon in 2005, you know, if we'd have said to you, it's going to wipe out Barnes and Noble and Borders, and by the way, it's not just books that are going to go digital, you will buy all sorts of things across this platform and it will get towards the everything store, you know, people would have laughed at us. Our point was not that it was definitely going to do this, or even that that was the most likely scenario. Our point was then as now, what if these companies succeed, and compare that to the capital we have invested, which we put at risk. And that's how we think about investment risk, the long-term destruction of capital through getting our investment decisions wrong. And you look at that and say, well, actually what other businesses look like. And you had Facebook that became a public company at $100 billion. Alibaba that we bought at $45 billion was already the commerce structure in China back in 2012, but still a private company. You know, wind forward and it becomes a public company at 168 billion on the IPO price tag, but realistically in the first day of trading it jumps to $200 billion. This is not two guys in a shed. The largest unlisted company we hold transacts more payments per day than Visa, a multiple of the number of transactions that Visa does, and is north of $150 billion in valuation and still private. That's Ant Financial. So it's really saying, you know, in order to do what we do for shareholders, which is try to catch that long run compounding of returns from the growth in these businesses, then we need to be able to adapt. And the investment trust structure whereby our shareholders can buy and sell shares in Scottish Mortgage on the exchange without us having to buy and sell the underlying portfolio investments is a great way to be a disciplined long-term investor in businesses. And we think as investors, you have to be very clear about where you can get a competitive advantage against the market. And timing short-term market moves is an incredibly crowded, well-funded space where it's not clear to us you can actually generate a clear competitive advantage. However, being prepared to think about long-run business opportunities and the valuation over the next 5 to 10 years is very much the road less taken. And that's where we think we can actually add value for our shareholders. We're not being paid to track the market. We're being paid to take a genuinely active view on what the best companies are. And so we need that flexibility to maintain our opportunity set.
James, is this a trend that we're seeing across the sort of the closed-end fund space?
Closed-end markets always had a fairly chunky private equity sector, but it's a very different thing to what Scottish Mortgage is doing. I think part of the reason that Scottish Mortgage has been so successful at the moment is it's one of probably the only way I can think of where we can actually get access to those really big, potentially global tech giants mainly based in the US still. One of the strange things about the UK market is we've got very little exposure to technology, despite the fact that obviously this, what we're talking about, this is the main driver of change, and it's a great shame. So the private equity market here is, a lot of it is the kind of buyout type stuff, which is more established companies. That doesn't necessarily mean they're not necessarily, some of them are still in the new growth industries. If you look at something like HG Capital, that's it's looking at technology and media and that sort of thing. So it's similar version to what Scottish Mortgage is doing, but in more European, UK based. Venture capital, which is probably earlier stage than what Scottish Mortgage is doing, is being in and out of fashion, tends to be much, much riskier. And that was the sort of thing that Woodford was doing. And you can see, we saw how he struggled to pull it off. But there are there are dedicated funds like Syncona, which is the biotech one, where it's actually investing in very early stage drug development therapies aimed mainly at cancer. And I think it's got a great platform and is growing quite steadily. So there are other opportunities for Scottish Mortgage, but in terms of accessing these big global technology companies of the future, Scottish Mortgage is one of the few ones that are doing it. It's got sister funds, like there's Pacific Horizon, for instance, which has got a lot of interest in the Chinese ones and has made a lot of money out of that. And other funds have dabbled in that area, but not to the same extent that the Baillie Gifford ones have. So.
Okay. We're going to take a few questions now from the audience. So first one, what does the panel think about the prospects for shared office space companies, such as Workspace and WeWork? And that's an interesting one, because I think it's unclear at the moment as to which way that one might go. So what do you think to that one, Catherine?
James, I was going to say, maybe that's one that we can, because we get asked about why didn't we invest in that? And I think this comes back to, there are a few things. We touched very briefly on governance before, and we would say that at the end of the day, very often, if you're investing on a 5-year view and beyond, management is almost all that matters, because a great opportunity can pass by a management team that don't know what they're doing or haven't got the willingness to invest to go after it. If you're investing for a 3 to 6 month time horizon, then that probably makes much less difference. Our challenge for WeWork is to say, this is an old-fashioned perhaps consideration, but we look at cash flow dynamics of the businesses we end up investing in. At the end of the day, earnings, we just think are at the end number of accounting. Businesses live and die by their cash flows. And so if you're trying to fund long-term liabilities from short-term cash flows, at some point, particularly if your competitive advantage is access to external capital, that puts you at a much riskier position than a company like Amazon or Alibaba, which is funding tomorrow's projects from today's cash flows. And so it's about the underlying dynamics of that business rather than that. And the part about WeWork that I think sometimes gets missed is that actually they managed to convince people to work in actually a much smaller square footage than had been the case before. So there clearly was something there, but from a business perspective, a long-term enduring business perspective, we just couldn't make that dynamic work in terms of what we're looking for the handful of businesses, because you're very dependent on external capital. But the behavioral point is also quite important. If you look at the companies that we invest in for Scottish Mortgage, they tend to be either family run, multi-generational, or founder run. The likes of Alibaba's talking about a company succeeding over 2 centuries with a clear partnership structure and transition of power. Amazon is not just Jeff Bezos, it's Jeff Wilkie, it's Andy Jassy, and they're big shareholders. They own the same shares that we do. And clearly, if Jeff Bezos was in it just for the money, he could have left Amazon a very long time ago. He's in it to create a business. And it's that sort of extraordinary, enduring passion for these businesses that really drive them into the future.
Okay. Next question. Would you recommend healthcare, antivirals, vaccines, these kinds of companies for emerging viruses? And are contact tracing developments a good pickup in the short term? James, I'll let you answer that one.
Okay, so if you think, I suppose the question is driven by what's going on with COVID. And we've seen an awful lot of activity in sort of three different areas. One is, can we tell who's actually got it? Second one is, can we treat the people who've got really bad symptoms? And the third one is, can we vaccinate people against it? And the testing sort of side of things is being ramped up, as we know. The treatments, we are still testing various things, but it seems like Gilead's remdesivir seems to be working. So Gilead is a big American biotech company, so it's a big holding in funds like Biotech Growth and World Healthcare. And maybe this will go some ways to helping towards something, to treating people. And other things they're still developing. And then you've got various vaccines on trial as well. Again, Biotech Growth, we're talking about CanSino Biologics, which has got a trial going on in China now. So there's an awful lot going on. I keep thinking, yes, this is all great. It's all a very good example of how the biotech industry has changed and how fast they can respond to things, and how much broader the range of things that they can treat is. So this is why it's a really good investment long term. But I don't see that any one of these companies could make supernormal profits out of treating something that everybody wants a treatment for, and probably governments will give away for free. So I don't know. It's one reason why the biotech industry is going up, but not the only one.
Okay. Does the panel see any upside for the airline industry over the next 1 to 2 years? Catherine? No.
We don't own any airline stocks in the portfolio. I think it comes back to, we're only looking for a handful of companies that really have an extraordinary opportunity set ahead of them, and we haven't found that as an area. One of the benefits we have is that we can, as the opportunity sets change, we can flex. We are not forced to hold one of anything. We don't have to hold a bank in this region, because we just invest on the best ideas portfolio. And I think as different sectors come under different pressures, that flexibility is quite important, rather than being forced to hold something in any area where you don't actually think there's a potential to make returns.
I think a bunch of airlines are going to go to the wall, but an awful lot more will be bailed out by governments as kind of national champions. And that just means that they're competing on the sort of false premise that, that they're not really dependent on generating proper returns. So I just think that depresses the returns for this industry for a long time going forward.
And Warren Buffett, of course, recently sold out of his airline companies, didn't he? So maybe that speaks volumes. So next question, on Tesla, didn't you think it was a fairly cynical move on the company's part to issue a heap of new shares immediately after the large ramp up in price last year / early this year, Catherine?
So I think we've touched on it before, so I'll try not to repeat myself. It's a car company and it's ramping up production. It's talking about a new factory outside of Berlin. We know that it's a capital intensive industry and that it needs to continue to raise capital. We factor that into our investment case. And actually at this point, having that capital already raised looks fortuitous. But I think you have to be honest as well in these things, in that it looks fortuitous rather than they had any better insight on what might happen to markets in a COVID world.
Okay, another one for Catherine. Will Inditex survive the move to online growth?
So for those listening who are less aware of Inditex, Inditex is an extraordinary business created by a gentleman called Amancio Ortega, and it runs Zara and Massimo Dutti and other brands on the high street. It's been phenomenally successful at actually listening to what customers want and then making that, rather than trying to make things and then convince their customers they want it. And that truncation of the supply chain has been extraordinarily successful for them. But their business started on the high street. And one of the things in recent years that we've been doing is talking to them about, well, what about the threat from online retailers? And we own Zalando, the largest clothing retail platform in Europe. And that conversation has been really illuminating, because you want to see management teams that not only can see the threat coming, but then want to embrace it. So actually Inditex was saying, this is a great opportunity, because if you wind back a few years, people were very nervous about shopping online. because of the returns. But for Inditex, they could say, well, you can buy online and then you can take it back to our store if you want. And we're fine with that, because then you're going to walk past all our other ranges when you take it back, if you want to do so in store. So we can actually use this to enhance the customer experience from what we already have. But it is very challenging to compete in this space. And we have seen the growth of Zalando. One of the things that I think, when people are thinking about the dominance of the first wave of really large ecosystems like Amazon, is that the notion that you can't compete against that is changing. You know, from companies like Shopify, Zalando, which has created the dominant clothing retail platform in Europe, that was a company created out of Berlin by a group called Rocket Internet, that we bought in the initial public offering of that company. You know, it is possible to carve out large niches and offer something particularly useful to your consumers that then people use. And once you have that dynamic, then that becomes very important. Interestingly enough, Inditex has allowed a number of its brands, including, for example, Massimo Dutti, to be sold through the Zalando platform.
And we're going to finish on the $64 trillion question. And I know you guys aren't going to like this one, but I'm going to ask it anyway. Is this current rally sustainable?
Shall I go first?
I don't mind, I don't.
There is, yeah, it depends on your time frame, I think. My best guess would be that there may be a second wave. There may be a sudden realization that we're not in a V-shaped recovery, and that some companies are going to struggle. We might see genuine unemployment rather than furloughs. So I can easily see a situation where people start to get a bit miserable and the market comes off again. But that doesn't mean that the trend towards the Scottish mortgage type stocks still performing very well doesn't carry on going over the long term. Because as we said, this is what the point of this discussion is, if these are the long-term survivors, if these are where the real growth is coming from, then that's where the value will concentrate. So I can easily see a pullback, but not necessarily an end to the rising market. And then the other thing that's driving this is just this huge amount of liquidity sloshing around the system. Interest rates are not going to go back up again, I don't think. And governments are going to carry on with bailouts and all sorts of fiscal moves to try and stimulate economies. And that's all going to help feed back into the stock market and keep it going up.
Catherine?
Yeah, so I think it's hopefully those who are familiar with Scottish mortgage know that we don't try and time in and out of short-term markets or predict their path. There's so many factors that go into that. I'd add perhaps the US election that's coming up later this year amongst all the other areas. And I think having a sense of you can know is just impossible. What I would say is an interesting dynamic that we see in our own portfolio is that if you look out over the last decade, for the 10 best performing holdings we've had that made the biggest difference to Scottish Mortgage's portfolio, every single one of those, without exception, has had a period, if you do it on a rolling 12-month basis, of huge double-digit drawdowns in their share prices, and then moved. And if you look at the share price of Amazon since we've held it in 2005, it has totally done this. But what you end up seeing when you pull it back to that period is that actually you start to see that trend line. And all we're trying to do is say, we're trying to give you the trend line. We're not trying to get too specific about timing in and out on the short-term moves, because we just can't understand how you can, with any degree of certainty, predict that. And actually, if you're willing to take that longer-term approach and look through these things, the structural drivers that actually have much wider benefits that we've been talking about today, from that also impact healthcare as well as energy generation, should drive both industries and progress over the coming decade. And that actually, that Hans Rosling's work on this, the quiet progress, is really important, and a positive note, I think, to end on here.
Definitely. So time in the market rather than time in the market. Yeah. So that's the end of the webinar. Don't forget to sign up to our mailing list if you haven't done already. You will get a follow-up email with a link to the next webinar, so keep an eye out for that one. And I just want to say thank you to both our panelists today. It's been a really interesting discussion. And thanks to you all for listening. So take care of yourselves, and we'll see you next time.
Thank you.
Thank you very much for your time. Thanks.